Real estates are expensive investments. People need large chunks of money to invest in them, and they're complex transactions. You're trying to understand the market value, the market potential, realization, and there's a lot of work that one needs to do in finding tenants and securing renters and a lot of stuff. It's not really for the common man at the other end. But that's where REIT comes in as a great investment tool. REIT stands for Real Estate Investment Trust. It is what mutual funds are for the stocks, that REITs are for real estate. Very simply put. Now, what is a REIT? A REIT is nothing but a securitized asset that is put into an investment trust. The investment trust then floats a public issue where investors subscribe to the units of the investment trust. The investment trust core holding is the real estate. So it could be an IT park, which is the core asset. Now the IT park has tenants, which are the IT companies which are using the facilities of the IT park, and in return are paying monthly rental to the IT park. Now 90% of all the receipts of the REIT then gets distributed among all the unit holders. That's really the principle, the funda of a REIT. Now in India you have two types of REITs. Like I said, there is the real estate investment trust. There are also asset-based investment trusts. Now the same principle of securitization of receivables can also be done for a bunch of assets. And in India, we also have assets like distribution companies, which have also created investment trusts. IndiGrid is a classic example of a company who is into power transmission. Grid, they maintain power grids, which means the power from the power station generating place to the consumers is transported through a grid of power lines, and that's owned by a company which has securitized it through an investment trust. That is also one example of an investment trust. And of course you have Embassy, Mindspace, so many players in the space of Brookfields, which have all done their own investment trusts. Now let's look at, as an investor, what do you look for in terms of a REIT? Typically, our belief is that the returns from a REIT will be more or less in line with a debt investment. But then if it's almost the same as debt or near to a debt investment, why at all should I subscribe to another instrument that is on par with debt? The simple reason being that we need diversity in our investments. We have equity, we have debt, we need some form of real estate. Holding physical real estate is difficult, challenging. Like I mentioned in the beginning, it has its own set of challenges. But a REIT is a fairly easy way in which you can go to the stock market, buy the number of units you want, and hold it as long as you want. And if you need liquidity, sell it in the market and you will get your money back in 3 days. How cool is that in managing real estate? So that's where REIT comes in as another example. We believe REIT has a long way to go in India. It's a product of a recent origin. Less than 5 years, 10 years of serious REIT investing has happened in India. Long way to go. But for the investor, there are 4 sources of revenue that the REITs can give you. First, the REITs will generate dividends based on the return that the principal asset provides at the end of each year. Like I mentioned, 90% of all the receivables net of expenses has to be distributed by the REITs, which means a set of cash flows will come back to the investor on a quarterly basis or on an annual basis, depending on the way it is structured at the REIT. Second, if the REIT generates interest income, that also will be passed through to the investor. So dividend is one source of income. If the REIT also generates interest income, he will get interest income. Third is repayments that one will get from REIT in the form of whatever loans that the investment company has made. It gets the money back as principal. That principal will also paid back. So in a bunch of projects, if the investment trust exits one of the projects and gets a capital repayment, that will again get distributed among all the unit holders. That is what we call a repayment of principal. And last is, of course, capital gains. So when you sell your REIT, you're looking at a gain on that REIT. That gain also comes as an income. So these are the 4 sources of income one can hope to have from a real estate investment trust. But like I said, the dividend interest, which is more the regular ones, together with the repayment, these two may not be largely different from a debt fund. In fact, real estate yields in India are pretty low at this point in time. So the rental yield inclusive. So we can't expect great amount of returns to start with. But the magic is, as long as you hold this asset for a reasonable period of time, and every 3 years the rental rates reset. So there's a 10% hike in the rentals, plus there is also a 10-15% hike in the property value. So eventually over a long term, 5-year, 10-year, 15-year, you'll find that REITs are generating much more superior returns than what the interest that you earn in a traditional investment product. So from that perspective, we continue to believe REITs are a great asset for a diversified product. We don't think you should allocate too much to it, but from a debt perspective, you should have another product in REIT as well. Today, REITs can only be purchased from stock markets. You must have a demat account and you must go there and buy the REITs. They are in very low denominations. You can buy in minimum units of 100 or 150 or 200 as the case may be, and the prices are limited. So they are retail in nature. It's not so complex to kind of do that. We're also believe that SEBI is approving a bunch of REIT-based mutual funds, which means mutual funds that will invest in REITs are coming up. They already invest also in a small way. Some of the debt funds and mutual funds are already investors in REITs in a limited way. But since the total REITs pool is not very large, today that number is still low. But we do expect that eventually you'll have exclusive mutual funds that will invest in the REITs that will provide a greater diversification as well. So from that perspective, REITs are great products to invest. Why one must consider simple products, no big capital expenditure, capital outflow from your end, easy exit, 3 days, sell it in the stock market, you can walk away, and hassle-free. You are not going to appoint a tenant, you are not going to collect the money, you are not going to handle the repairs. It's all done at the REIT level itself. So to that extent, it's a hassle-free way of participating in real estate for an investor, and I think it's a brilliant product that's been constructed. But we will examine 2 aspects of REITs more in detail. One is, what is the actual cash flow that REITs have generated over the past few years? We'll look at across different REITs. We'll do that examination. The recent taxation has added a bit of a confusion. Of course, we now know that interest is taxable, dividends that you receive is taxable. There is also another repayment and capital gains as a small modification in the tax structure. We will also explore that more in detail as far as REITs are concerned.
For the performance of the REITs, we have taken the inputs from indexscreener.in, which provides a kind of a nifty index performance of all the index funds that are available in India, both the real estate based and the non-real estate based funds. As on current date, which is mid-September, the price earnings multiple of index funds is 74.65. The price to book value is slightly above 1, which is 1.15. The weighted average dividend yield of the entire bunch is about 8.27, which is very impressive. At an individual REIT fund, this could differ a bit here and there. But overall, I think it's a very interesting higher number. As an investor in a REIT, the taxation is involved in 4 parameters. The interest is taxed at the actual slab rate of the investor. The dividend is exempt from tax because it is a pass-through. Capital gains is taxed on the basis of short-term capital gains at 15%, that is less than 36 months, and long-term capital gains at 10% after the base slab of 1 lakh per year for an investor. Now the last component is loan repayment. Now as far as loan repayment is concerned, as long as the loan repayment is not in excess of the issue price, then it is not subject to tax. But the moment the loan repayment exceeds the issue price of the units, then the income will be charged as income from other sources in the hands of the investor. Now, this new regulation came about in the budget of 2023, which said that amount received as loan repayment, once it is reduced from the cost, if such amount is distributed by the trust and it exceeds the issue price, then it will be taxed at the maximum marginal slab of the investor. And this is important because many of the REITs in India have given a reasonably large proportion of money back to the investor in the form of loan repayment. So the taxation relating to loan repayment becomes an important component. So it's extremely important for the investor to know what is the issue price, what is the distribution of loan repayment per unit before buying the units, and distribution of the loan repayment during his period of holding, and whether the total loan repayment exceeds the issue price. In some sense, this increases the complication relating to taxation and how it is accounted for. Having said that, it is a regulation and therefore it needs to get followed.